Is the market saying that inflation has peaked and will fall from here, or should the signal from Bondland just be ignored? Joining me now is Barry James, president of James Investment Research, and Michael Schumacher, head of macro strategy at Wells Fargo. I'm going to set Michael up here by letting Barry get the first response, Barry, on what emphasis you place on the level of bond yields right now.
Well, as we're looking at it, it's expectations. That's all it is. If you look at from 2 years to 30 years, the break even in terms of inflation is around 2.5%. So that's what everybody has locked in their brains. If this is the peak in terms of inflation, then and it's going to be heading down, then everything is all smiles, and we can go to the bank, as it were. If it's not, then I think the Fed is going to be taking the punch bowl away, and that could cause some real problems.
And I want to turn to you on that, Michael. You're our bonds, our rates guru. What would you say are the levels to watch from here on the 10-year?
Yeah, Kelly, it's interesting. I think that if you get decent upside next week after the Fed, that's probably a telltale sign. So something like 165, 170, if the market happens to get there. I realize it's a bit of a lift. That's a pretty, I wouldn't say dire, but warning signal for the market as year-end approaches. Liquidity is usually pretty poor. We think yields can go up a fair bit from there, but probably pretty gradually. It's not going to be just a huge jump up, but something like 10, 15, 20 basis points over the course of a month, maybe a bit more down the road, that sort of thing.
Barry, let's talk about some of the places in the market you like. Home Depot, SVB Financial Group, Old Dominion, all names that have already had pretty nice years, but you think this can continue?
Yes, and when we're looking at the market, and especially in this inflationary environment, you want companies with pricing power. So you look at their operating margins or their gross profit margins, and if they're able to increase in spite of the higher prices, then that's a good company. Also looking for real quality. You're not going to try to chase things like, we don't chase the junky stuff in our Golden Rainbow Fund. Those are the names that we mentioned are in there. What we do try to find are the companies that have low debt and they have very solid balance sheets and they're not super expensive. Those are the keys for right now. And those kind of companies in a balanced approach, value growth, both. This is going to be a really volatile market is what we believe. This whole thing, this choppiness with inflation and interest rates and Omicron and everything else, it's going to be very, very rotational. And so you want to be balanced. Don't try to put all your money in one area.